Welcome, everybody. This is Charlie Epstein here at the 401k Coach, and I'm welcoming you and thanking you for taking the time to listen to this in our series of the Big Idea Focus Group. We are focused here at the 401k Coach on what I consider to be big idea thinkers in the industry, those people that are having significant impact, or in this case, our guest today, Mike Alfred, is somebody that I think is really a maverick of our industry. And I can remember when I first met Mike. Mike, how many years ago was that? We met, I think the first time was at an ASPA conference, I believe. You walked up to my booth and started
that was March. That was March 2009.
March of 2009, and Mike is the CEO of a company called Brightscope. For those of you that are new to the industry, and Brightscope is based in California and San Diego, correct?
In San Diego, correct.
Right. And at that time in 2009, you were just launching, weren't you?
Yeah, we launched the site in, I think it was January 29th, 2009, and we had 800 plans rated, and all you could do on the website at that time was type in, the name of your company, IBM, Lockheed Martin, and see the 0 to 100 score. So it was very simple back then.
So a lot of people have heard of Brightscope, but I don't know if they really understand completely what the company does. So why don't you tell us a little bit first about your background, how you came to this industry, and how you came to the idea of Brightscope, and what was the genesis of that?
Sure. Well, I grew up here in San Diego, California, and I went to Stanford as an undergrad, studied history, but I actually spent the vast majority of my time, my first year or two in college, trading stocks, high volatility, small cap, penny stocks. That was the time to do it, the late 90s. You could buy something and literally an hour later be up 80% on it. Obviously not a good model for how to manage money for the long term, but I learned a lot through that process. And so when I graduated from Stanford, I decided I wanted to help individuals manage their money, and I started at a broker-dealer here in San Diego initially, and didn't really like the model. I mean, it was basically get on the phone on Monday nights and cold call people for 3 or 4 hours and go out and visit somebody's grandmother, review their term life policy, and see if they had any other needs. And in retrospect, it was a great training ground, even though I found the work a little bit distasteful. Learned a lot, though, that now kind of helps us at Brightscope. My brother and I, we didn't want to do that type of work anymore. And in about 2005, 2006, we decided to really push out on our own, and we borrowed a bunch of money on our credit cards to open up our own registered investment advisor here. And so it was just two guys in an office with CNBC on, and we had an intern and our name on the door and said Alfred Capital Management, and we managed to cobble together about $10 million to manage. This is in 2007. And right as we were starting to think about, how do we go from 10 million to 50 million to 100 million, we came up with the idea to score every large retirement plan in the U.S. And that's sort of when we decided not to manage money anymore and really start a business.
So you were, and where did that, that's really fascinating to me. And for those of you listening, I've been in the business for 33 years, started in the life insurance industry. I think there's some similarities there, and have stuck with it. But you and your brother had this moment where you started thinking about actually rating the investments that you were selling to people. How does somebody do that?
Well, I mean, it's funny. When we were in the broker-dealer office with a bunch of other registered representatives, a lot of them hadn't gone to Stanford or Harvard for their undergrad, and some of them hadn't even graduated from college at all. And oftentimes they would look at me and say, "Mike, what are you doing here?" I literally had somebody say that to me, and I never thought of myself as being better than the work. I really dug in there, and I worked really hard to try to build a client base and learn the business and understand how it worked. But there were some moments, when we were using Morningstar's Principia Pro or Advisor Workstation to build a portfolio for a client, where Ryan and I looked at each other and said, "Wait a second, this is so much cooler." How do you become the guys that build the software that powers the industry or gather the data that drives decision-making rather than be the person who actually delivers the advice directly to the consumer? And
right,
so we were thinking all the way back in 2005, 2006, how do we kind of extract ourselves from the day-to-day of doing the business and actually build the tools that drive the business? And so it just was a matter of time once we decided that that was important. At the time, it didn't seem like there was an obvious path because, you're sitting there, you're accumulating credit card debt every month that you're not generating production. and you're imagining this world where you're now the CEO of Morningstar. And so, that's a big jump mentally to make. But I'll tell you, one of the most gratifying things about what we've done at Brightscope is we went from selling, an MFS, a mutual fund, or a John Hancock product, to now sitting with the most senior executives at companies like that and helping to advise them on their strategy. It's a pretty big jump to go from where we were to being sitting on sort of the same table with them at their home office and really helping them drive strategy across the company. But I'll tell you, it's very worthwhile to make that leap.
And a huge, big idea in terms of influence and impact, right, in the business, because now instead of influencing, I was just this past weekend with some pretty big thinkers. One of them, David Bach, who wrote The Automatic Millionaire and wrote, Smart Women Get Fast, but Get Rich, Get Smart series. And David's been a New York Times bestseller 4 times at the same time. And one of the things David had said, he was in San Francisco working at his father's firm, and he said, I could either get 100 people with $1 million in management or 100 million under management, and that would be my life. Or I could start talking to the average consumer and impact hundreds of millions of people. And so that's what you've done, right? You've gone from impacting a few people to now impacting an industry. So let's talk about what it does. What does Brightscope do in your words? And we'll talk a little bit about differentiation between Morningstar and that kind of thing. But so there you were, and now boom, we flash forward. So the transition to just rating funds has gotten bigger than that. So what does Brightscope actually do?
Well, Brightscope is a financial information business, and you can really put us in the same category of firms as FactSet, Bloomberg, Thomson Reuters, Morningstar. Obviously, those are firms. They're much bigger. They're our role models. But when we think about how we're building Brightscope, we definitely look at those companies, their trajectories, the way they do business, the strategy, and whatnot. And where we really started is in the Morningstar mold. Morningstar really made their name by publishing ratings for every mutual fund in the U.S. and really driving consumer awareness about the importance of understanding the quality of your investments. So that includes things like fees and performance and holdings and manager tenure. These are all terms now that are very common for folks in the investment industry to understand. But in 1985, when these ratings started to be published, a lot of consumers were still buying 7-8% loaded funds that were wildly underperforming the benchmark, and the only reason they were acquiring them was because some wirehouse financial advisor had sold that product to them. And there was no sort of independent, objective way to evaluate that. So when you look at what we've done at Brightscope, we said, where else can we bring that same type of transparency, that radical transparency to the consumer? And retirement plans is a huge market where, because there's so much intermediation between the consumer, the end user of the product, the end buyer of the mutual fund, and the actual maker of the product, because there's HR managers and consultants and all these folks that sort of serve as the gatekeeper between you and the product. Historically, there hasn't been any transparency, so we said one way to attack that is to publish, in the same way that Morningstar did, publish a quantitative rating in the marketplace that could then drive better decision-making by all the different players in the ecosystem. And so we started with that consumer-facing rating, which is what we started with in 2009. But just like Morningstar, there's a lot of value in then filling in with products for each of the various players in the ecosystem that drive it. So in our case, we built products for the large plan sponsors. So we have software that is used by Lockheed Martin and Google and McDonald's and Thomson Reuters, these big companies that want to evaluate how good is our 401k plan relative to other companies and what can we do to improve it. We built software for financial advisors who want to identify plans that, say, have a underperforming fund in large cap or that have high fees relative to a similar peer set of companies in the same industry. And then we also built products for large financial services institutions, whether that's asset managers, broker-dealers, and custodians, that aggregates all this data about the market and can help drive more efficient decision-making relative to things like sales and marketing. If you're trying to figure out how to staff a territory, it's helpful to know which advisors are actually driving the most business for you in that territory, and what other business are those advisors doing with other firms, so you know whether there's an opportunity to win more share. So again, it's very, very similar to the Morningstar model in terms of.
But I want to point out to our listeners something, because we here at 401k Coach are really focusing on big ideas and how do advisors and people in this industry get their big ideas launched as well. There's a lot of folks that may not be unlike you and your brother, but they haven't hit the switch because they don't know how to do what you did, not in your industry necessarily, in your bailiwick, but in something specific. And one thing that you said was at Bloomberg or Morningstar, these are companies that are and were role models for you. And what is it that you did by having role models? How did having role models help you and your brother and the company really grow and scale your focus? One of the things I heard you say is we looked at what they were doing and then looked at what wasn't being done in a similar fashion. So what was missing is what I heard you say.
Yeah, so I mean that's a key point, but I think the most important thing is that there's an infinite amount of decision making that needs to happen as you're building up from an idea into a real company. And one of the hardest things is without the perspective on your own, because obviously a lot of people are first-time entrepreneurs like we were. You're relying on case studies, advice from mentors and all that, but one of the best things to do is sort of put yourself in the mind of a firm that you admire that's already been successful and say, at every single juncture along the path, what would Morningstar do here? 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 And so like when you look back at the very beginning, there were a lot of conflicting and distracting ideas that we could have followed, a lot of paths on the logic tree that we could have gone down that would have ended up leading to an inferior outcome. Mm-hmm. One of those ideas was, well, let's help participants manage their portfolio better. Well, sounds like a good idea, right? But when you really think about it, there are a lot of different solutions out there, whether it's financial engines or guided choice or advisors that already serve as a fiduciary to the plan who create models. Right? So if we had gone down that path, maybe you never would have heard of Brightscope. But when we really looked carefully at what hadn't been done and also what had been done by Morningstar and Bloomberg and others in order to break into marketplaces in the past, it was very, very clear to us. It crystallized around this idea of a simple quantitative rating projected all the way to the consumer through the web. And we knew that, unlike Morningstar, we have the Internet as a distribution engine, so we could ramp things up a lot faster. I mean, back in the mid-'80s, you had to basically print out the reports and take them to a conference to get anyone to look at your rating. We could launch a website, and within the end of the first week, CNN was calling and saying, we'd like to have you on to talk about how people can learn about their retirement plan. Right? That's a huge advantage that an entrepreneur has today that they didn't back in the 80s.
Right. So let me ask you, I mean, with the impact of technology and the brain power that you and your brother and the team that you've put together, how is the business doing? Give us some ideas of how you're doing, how you've grown since 2009.
Well, it's been pretty fantastic growth from my perspective. I mean, it's exceeded our expectations. Today we have nearly 70 employees, so that's 70 jobs. We're not going to solve the crisis of the jobs crisis or the retirement crisis on our own, but certainly in our own small way, we're trying to make an impact. We've grown our revenue substantially in the last 3 years. We've grown more than 60% every year, and we've generated a positive cash flow each year, and we'll continue to do that this year. We've raised 3 rounds of funding that totals a little under $6 million. And we've signed some of the largest companies in the world as clients. Currently we have 6 of the top 10 global asset managers as clients, as well as 8 of the top 10 record keepers in the retirement space. So in terms of coverage of the firms that you want to do business with and know that you're a brand that matters and you're a company that matters, we've exceeded our expectations, and we seem to have more momentum going forward. I think the one way you'll be able to tell whether we're successful in a couple ways. One is, do you hear the right names in terms of customers in the marketplace going forward? Do you hear the top financial institutions and the top companies around the country using Brightscope? And then the other way is just watching as we grow our headcount, because in a lot of ways headcount is directly sort of proportional to the success the business is having. We have to hire more developers, and we have to hire more support staff because we have bigger and more demanding customers. And so as we go from 70 to 100 employees next year, you'll sort of be able to get a sense that the business is continuing to grow.
That's fantastic. Now, I want to come back to Morningstar because you mentioned role models, but I think oftentimes you're compared to Morningstar, and I don't know if you feel that's a valid comparison. So why don't we talk about what are the similarities and differences between Morningstar and Brightscope so our listeners really have a clear understanding of that?
Yeah, obviously incredibly fast. Yeah.
Mike, I think we lost you just for a second there. Mike?
Hello?
There you are.
Yeah,
Let me ask you.
Yeah, go
You
ahead.
there? Yeah, let me ask you that question again because I asked you and then you faded out. So, you talked about role models, Bloomberg, Morningstar. So let's talk a little bit about Morningstar because I think you're in the industry often compared to Morningstar. So do you feel that comparison is valid and what would you say? Well, first of all, do you think it's a valid comparison?
Yeah, so first off, we're incredibly flattered anytime we're mentioned in the same sentence. With Morningstar, there are certainly similarities, one being that we're very focused on the consumer. Just like Morningstar, we build tools for the industry, but at the end of the day, a lot of the value in what the work we do accrues to consumers who now have access to better and more complete information about the products, services, and whatnot that they acquire in the financial services marketplace. And so we're trying to drive that efficiency. In terms of how we're different, Morningstar is really focused on products. So Morningstar will tell you that this mutual fund is 3 stars and this mutual fund is 5 stars, and that this manager has been here a certain amount of time, and that the fees are this amount, and that's how this compares to other funds in that category. What Brightscope is really focused on is how products are actually distributed. So we're looking at the 2 major distribution channels, the 2 largest distribution channels for mutual fund products, which are retirement plans and other pools of assets like retirement plans, as well as financial advisors. When you're an asset manager, you're a large global asset manager, the large broker-dealers and the other aggregations of advisors, whether in the form of an RIA or other types of firms, that's going to be one of your key areas of focus if you're trying to figure out how to sell more of your product. And so we really view ourselves as sort of the Morningstar of distribution channels rather than a firm that looks at the products themselves.
Great. So since you started in 09, you've really been focused on the financial institutions, financial advisors, and I want to talk about the whole financial advisor market and that industry. And you mentioned early on when you thought about creating tools, to help participants that you didn't go down that path. But are you focused on the consumer? You just sort of talk a little about the consumer and what's coming down the pike. What do you have in store for them?
So as it relates to the retirement plan part of our business, there really isn't a lot that can be done to change outcomes dramatically without the participation of the industry. And so we really believe that our biggest contribution to the participant on the retirement plan side is going to be through the improvement in the knowledge and the data available to plan sponsors who hopefully will make better decisions, to asset managers and record keepers who will refine their product mix and their strategy relative to what they see in the data that they're receiving from us. As it relates to the financial advisor piece, though, there's a lot more opportunity to help consumers. And so one of the things that we're looking at is increasing the amount of information available about fee structures from the ADV Part 2 that are filed by a lot of the registered investment advisors. So that's kind of one of the key steps we're undertaking right now. We have a lot of that data ingested into our systems, but we haven't actually surfaced it on the public website, and that's coming. We're also rolling out a wizard of sorts, which will help consumers based on criteria that they input about who they are and what they want. We'll help them identify a short list of advisors that they should go out and interview when they're looking at either hiring a new advisor or replacing an advisor that they have. And then we're also digging a lot deeper into insurance products in particular, because that's one area of the market. There's a lot of data from Lipper and Morningstar and all these other firms about mutual funds. There's nowhere to go on the internet to look up and compare variable annuities, right, or universal life policies, and really dig into the details about what the differences are between these different products. And so we intend on rolling out solutions there to, again, help consumers make sense of all that data. So we're continuing to innovate on the consumer side. And we think, again, that goes right back to Morningstar as a role model. Morningstar has never stopped trying to add additional value to the consumer, and we'd like to follow that path.
And that leads me, I think that's brilliant, because that leads me to the enormous amount of change. Well, since I've been in the business for over 33 years, I always tell people change has been a constant every 6 months. And as an advisor, if you can't adapt to change, it's adapt or die, which I know you know very, very well. But in just the 401k market in the last 4, 5, 6 years, I think the acceleration of change has been immense. 482, 405A, the Department of Labor, transparency. What would you say, from your vantage point, are the greatest dangers an advisor faces today that if they don't eliminate those dangers will really impact their success?
Well, I think one of the things that's going to go away over time is indirect payments, revenue sharing payments and whatnot, which has historically really supported the industry. And so I think one of the challenges for all advisors is justifying their value in a world where the fees that they get paid are going to be more transparent and directly linked to some real value creation, as opposed to just a payment based on the size of the assets in the accounts. And so that requires a lot more thinking about how do I differentiate myself. What's different about the services I provide to a plan than what somebody else provides? Can I make money by charging a flat fee relative to getting paid based on the assets in the plan? Does the firm I currently affiliate with, actually allow me to act as a fiduciary to the plan? I think folks that either aren't asking those questions or don't like the answers to the questions, they either need to make a change or they're likely to be pushed out by specialists, folks that really do have good answers to those questions and are prepared to explain their value to a plan sponsor in a way that really makes sense, and of course rationalizes with the current regulatory regime, which is, I think, getting more difficult for advisors, and going forward, I think it's just going to get worse. I think it's going to be harder, frankly, to make money. It's not going to be as easy as just signing 5 or 10 large, mid-sized plans and then going on vacation and just getting paid.
Right. There's a lot more vigilance. There's a lot more work and due diligence that needs to be done. And, it's interesting you kind of bring that up, because as I watch the industry, especially you hit on the point about, and for our listeners, flat fee versus assets under management. I see the industry moving in that direction, but as fee compression has come down, and I think I'm not sure which came first, the DOL or Brightscope, 482 or Brightscope, the chicken or the egg, right? But as I look at fee compression that's happened over the last 3 or 4 years since 482, it's a good thing for the consumer. It's bringing the cost down. And I oftentimes find myself wondering, when do we get to ground zero, right? When do we get to, we will operate this plan free of charge for the opportunity to work with your employees to make them more successful. Interesting. Right. See if we're headed there or not. I was going to ask you, what one piece of advice you'd give to an advisor, but I think you just said it. I want to make sure our listeners didn't miss it, because it goes back to what you said about role models. There's going to be fewer and fewer of quality firms that can, A, work in this environment, B, be transparent, C, be fiduciaries, and D, add value at a reasonable fee, which meets all the objectives for the plan sponsor. It's funny, you and I chatted at the front end before we got started. I want our listeners to know we were actually out on a call today for a $40 million plan with my Brightscope report in hand, and having this exact conversation with a $40 million plan with a plan sponsor, didn't have an investment policy statement, wasn't keeping notes, and didn't know what revenue sharing was. So alarming. And between your tool and our capabilities, has now opened up this conversation, and they think things are going fine. It's the what advisors don't know that they don't know, but it's really also what plan sponsors don't know that they don't know. So just from your vantage point, because I know you get calls all the time, you're on the news, it's exciting to watch the growth. Where do you really see the industry at large headed right now?
Well, I think, you probably just hit it on the head in terms of the race to the bottom in terms of fees. I think if you look at it that way, it almost seems like an industry you wouldn't want to get into today, and I think there's going to be a lot of ways to look at that. If you look at what's happening on the internet today, a lot of things that people used to pay for offline are now kind of increasingly becoming free. If you look at what Google's done, they've had this raised earth philosophy where they'll do anything. They'll give everything, or they'll basically take any product where there's an existing market and they'll give it away for free in order to protect their core cash cow business.
Mm-hmm.
And I think you're going to see a little bit of that happening in the financial service industry, where there's going to be a few, 2, 3, 4, 5 big winners who have the economics to basically play that same strategy out in the retirement plan space, essentially give a lot of things away for free in order to capture some sort of value on the back end. You see that Vanguard obviously is a great example of a company that, from a strategy standpoint, is just knocked it out of the park. Fidelity, a lot of people root against Fidelity now because they're, it's just sort of human nature to root against the leader. But the reality is Fidelity's success in capturing rollovers allows them to go in and price plans on the front end in a way that they can't be matched by competitors, smaller competitors
Exactly.
that don't capture.
Yeah.
So I think advisors have to think about it the same way. How can I play out these more advanced, high-level corporate strategies within my own business? How can I essentially find a way to give something away for free or to undercut my competitors in return for capturing something that's maybe a little bit more elusive and harder for my competitors to grasp on the back end? And that's a way you can essentially win over and over and over again, because 95% of your competitors are never going to even grasp your strategy, and so you'll just be taking business from them, and they won't understand how you're able to justify the economics. That's up to you to figure out how that math problem works. But if you can figure it out, you can, in this type of environment where there's a lot in movement, you can win a lot of business.
It's interesting, too, as I listened to you, because I was going to ask you the question, how does a technology service like Brightscope and others disrupt the industry? But really listening to you, I found, I think the more important question is, how does Brightscope help serve where you and I are talking about the industry is going? So that strategy, and I think, again, I want to make sure our listeners hear it, that's a big idea. The idea that I would give something away from free for most advisors, because this is still a dinosaur industry, right, from an advisor's point of view, the majority don't understand that that's a strategy of going in and actually saying, we're not cutting your cost and taking anything away. We're actually going to provide you this service so we can provide you other services that we're going to charge for. And those other services are really sitting head-to-head, toe-to-toe, and really working with participants on creating successful outcomes.
And you think about it, it's really the exact opposite of what happens with the so-called blind squirrel today, where they're actually getting paid in a lot of cases for doing nothing.
Yes.
For adding no value other than knowing the CFO because they're the brother-in-law. Right? And so I think it's a flipping it on its head and saying, I'm going to add a lot of value at the beginning and not necessarily get paid directly for that because I know that the real value is elsewhere.
And also,
the ball's always moving. The most valuable thing in 1985 is not the most valuable thing in 1995, and certainly today with all these trends accelerating, the ball has moved. It's your job to figure out where the most valuable thing is that other people don't understand yet.
And so do you as a firm, does Brightscope, are you sitting and thinking and trying to anticipate the direction so you can add big idea value and services there?
Well, we've been trying to do that from the beginning. I mean, some of the metrics that we've branded and created have become sort of industry terms at this point, but when we started, they were things that we thought were important. Right, so we're both an accelerant of existing trends, and we're also trying to drive new trends.
Yeah, so what are those, so just give a couple examples of those terms so our listeners really,
Well, things like total plan cost. People certainly talked about total cost and all-in cost, and there were a lot of different ways of saying it. But, our methodology for total plan cost is now used by the Department of Labor. Right, the Department of Labor is actually one of our clients, and I actually can't say too much. There's a small list of approved bullet points that I'm allowed to use. Since I don't have them in front of me, I'm not going to say anything more than that. But in some ways, we're actually,
go ahead.
In some ways, we're actually driving the thinking about how to look at total plan costs and what the methodology should be there. That's just one example. And obviously, when we started, there was no high-level quantitative quality rating that had been branded across the industry that would show up in the Wall Street Journal and the New York Times on a regular basis. And that's, we thought that was really important. Somebody has to take a stab at it. People don't necessarily agree with Morningstar's rating for mutual funds. Every advisor has a different opinion on that, but the net result of Morningstar publishing those ratings over almost 30 years now is that the selection, the sample set of mutual funds available to the consumer has improved dramatically. So it's not about an individual outcome, right? It's about the net result to the industry, and that's harder to quantify. It's harder for an individual to understand. It's an ecosystem play. But we've really looked at, our high-level Brightscope rating, our total plan cost methodology, and things like that as real drivers of value, even if it's hard for the individual to discern what the value is to them.
So let's come back to the individual advisor or the advisory firms, because I know you have just some very visionary tools and support. So let's talk a little bit about, if I'm an advisor today and I come to Brightscope, what is it that Brightscope can do to help me scale and grow my business and support my big ideas?
Well, on the retirement side, we have a product called Spyglass that's used by your firm as well as a number of the top retirement plan-focused advisors in the country. And that tool allows you to basically query our database of plans, which, as you know, plans over 100 lives have to file an audited financial statement, and within that audited financial statement is a list of all the funds and the aggregate values in each fund. And so that by itself, if you're an advisor and you don't know how to go after a missing asset class or an over-allocation of assets into a fund that's a very high cost or underperforming the benchmark, you should probably not be in the business. So basically what we do is we make it very easy for you to build a targeted list of plans that fit criteria that matter to you, that you think you can add value around. And then you can go out and have a conversation like you did today with a plan and actually give them information about their own plan they didn't know yet. And that's a great way to start a discussion.
Yeah, and I can tell our listeners that's exactly what we did today. We had the Spyglass report with us, and actually the hour conversation that we had, we probably spent a good 20 minutes just in that evaluation process, which then allowed us to bring to bear our expertise using that data and information and have an incredibly impactful, intelligent conversation with the plan sponsor, disrupt that plan sponsor enough to say, you know what, I need to get you in front of the other two trustees, and we need to have this conversation. What more can you ask for? So that's
it. That's exactly how it's supposed to be used. And obviously in the hands of a skilled practitioner, it's even more valuable than it is for somebody who's just getting started in the business. But the other product that we have is called Advisor Pages, and that's becoming kind of a standard
this is new now. You launched that when? In
April of 2011.
Okay.
And the product's come a long way since then, and we're actually about to invest a whole bunch more money there because we think we're the leader there in the industry. It's a sort of a burgeoning new space with a lot of small competitors that are not well funded and who, frankly, the products just aren't there yet in order to be that useful for consumers. So we're going to keep investing there because we think it's a place.
Yeah. So tell our listeners what that is so they really understand it, because I think there's a lot of people that still don't know what that is and how valuable it is.
So we went out and we aggregated all of the information that we could get our hands on from the SEC, FINRA, and state insurance departments relative to financial advisors or anyone who calls themselves financial services practitioner of some sort and is delivering either products, advice, or whatnot to a consumer. So when you aggregate that information together, you can essentially build a profile of an advisor. Let's say it's John Smith, who works at a large wirehouse in Houston, and so we've got his his Series 6 and 7 and 63 and 65. We can see his insurance licenses, and we're aggregating all the financial disclosures and regulatory disclosures, customer disputes, the list of employers, and then we also allow the advisors to go in and customize those profiles with information they want a consumer to find. And really, the big breakthrough for us is twofold. One is just aggregating all this data from all these different sources. A consumer who wants to find information about this advisor in Houston is going to, if they can figure out how to get to the FINRA website and actually pull down a report, great. But they're not seeing all the other information that's available through the SEC website or through the state insurance department. And then the other thing we did is we made all of that information searchable through public search engines. So if you go to Google and you type in John Smith, wirehouse advisor, in Houston, you're likely to find the Brightscope advisor page. And so what's happening is we're getting about 370,000 as of the last 30 days unique visitors a month, and they're looking at about 1.25 million pages on our site every month. And so these consumers are reaching out to advisors and saying, hey, I heard about you from a friend, and I was doing some more research, and I'd like to sit down with you and talk about my situation. And so we're really serving as an aggregation engine for the data, but also a demand aggregation engine for consumers that are actually thinking about hiring a financial advisor. So there's a lot of benefit to an advisor to think about using that platform proactively, both to build their reputation online and control the information that's being disseminated about them, but also to connect directly with potential clients they might want to work with.
And so for our listeners, I have the opportunity to actually respond to questions that might come in from that person that's searching for somebody, and post that kind of information, or even post a response to somebody asking a question, a query in my area, and if it gets up on the Brightscope site, then I can respond, and that gives that person another opportunity to consider me as a qualified advisor in the area, knowledgeable advisor in the area. And I think the beauty of this, it comes back to something you said earlier, which is you're simplifying the complex, you're simplifying the search process for people, you're simplifying the access to information in one place, you're simplifying the decision-making process. It's brilliant.
We're also making it social, and I actually experienced this firsthand this morning. I was recording a segment for CNBC that's going to air on August 27th, and the segment just so happened to be about how to choose a financial advisor. I'm doing the segment with Sharon Epperson, and she's asking the interview questions, and I give answers about what a consumer should think about. And I actually posted a picture of me in the studio, put it on Facebook, and one of my Facebook friends, who happens to be a noted sort of nationally famous oncologist, reached directly out to me through Facebook and said, Mike, I'm actually trying to hire an advisor right now. Can you give me some recommendations? So I immediately turned and forwarded that to our internal vice president of our Advisor Pages product, and had him basically generate a short list of advisors near her zip code that had been well vetted, had no customer disputes, no disclosures, and it also answered a lot of questions so we could see the quality of the content they're creating and how they think about different financial planning issues. And so we sent those advisor names back to her, and she's already reached out to schedule an appointment. So talk about very personal there, because I posted a picture on Facebook. A famous oncologist saw it, asked me for a recommendation, and we used our engine, our Advisor Pages search capabilities, to identify advisors within a certain amount of miles from her zip code. And these are all things that back in 1985 would have been very manual. Would have been, do you know somebody in that area? Do you want to pick up the phone and call them? And now you can do a lot of it without ever picking up a phone. There's still obviously value in in-person interactions and picking up a phone rather than sending an email or a tweet.
This is brilliant, and I want our listeners to hear what Mike is really saying. Is it's about being actively engaged in the promotion process of you and your brand at multiple levels. That's really what you're speaking to. This isn't the old send out a letter and make a phone call or wait for the phone to ring. This is actively grooming and managing your brand and your professionalism. Are you going to, do you envision this expanding to where an advisor could actually post video, post information? How do you see that happening?
Yeah, absolutely. I mean, they already do post guides and answers to questions, and video is definitely on our roadmap. But I think there's a larger question of measuring influence, which in an offline world was sort of very hard to grasp, and it's very hard to grab a hold of. It's sort of ephemeral, right? You speak at a conference and you show up in the newspaper, but as soon as somebody throws the newspaper out, that influence is sort of gone. It may linger in the consumer's brain for a few weeks, but then they forget your name. Whereas online, you can actually track and measure your influence in a much more exact way. And so we're actually in the process of, and this is something we haven't announced, and so this will be the first time I mention it, we're looking at rolling out an advisor influence score, which basically aggregates all of the advisor's private presences and interactions around the web, sort of like what Clout does, but focus more on what's valuable.
I'm sorry, sort of like what does?
Clout, K-L-O-U-T, the service that helps an individual understand their influence on the internet.
Okay, that's news because a lot of our listeners may not be familiar with Cloud. That's great.
Yeah, so think of it as a financial advisor clout. And so what we're going to start to be able to see is how an advisor's activities on the internet, what they do on the web. Do they build a Twitter profile? Do they have a LinkedIn presence? Are they using Brightscope? How many consumers are searching for them? How many consumers are actually looking at their web presence? And if you aggregate that all together and you build an algorithm to score that, what pops out of that is a pretty good real-time indicator of who's going to end up building the biggest business over time. And so we firmly believe that 20 years from now, that'll be a very obvious thing to do. Obviously, there's a lot of 50 and 60-something-year-old advisors today who built their business totally offline and totally by referral, and maybe they never need to worry about this. But if you're, 40 today, you still have a lot of business development left ahead of you, and we believe that doing it in environments that are more measurable makes a lot of sense.
Well, you're leading me down another path because you just, as a 55-year-old advisor, the average, this too, the average advisor today is 57 or older. When you look at the numbers out there.
Right.
So we're in a enormous transition mode in this industry. We're a growing company, so we have a headhunter. We're actively out pursuing talent. I'm not making an announcement to anybody that I'm going anywhere. I just said I'm 55. But as I listen to you, I think about it's not only the influence, but there is I don't know if the right word is this model for attracting talent and helping grow the next generation of people in this industry, because quite frankly, there's a huge gap. The talent isn't coming up in the advisory pool as the older advisors move on out. Did you guys talk about this at all, or think about this opportunity as a big idea in terms of maybe how to match older advisors with younger advisors, because that's a huge missing in the industry?
Well, I'm taking notes as you say that. It's a problem I'm aware of. We haven't specifically talked about addressing it, but certainly to the extent at which we have all the information that is possible to be aggregated in one place, we could certainly help match older advisors with younger advisors based on a number of different characteristics that might be meaningful.
And then there's the whole acquisition side of the equation, because I talk with advisors about this topic of acquiring business. Some of our most successful 401k coach members have grown their business from, you mentioned 10, 50, 100 million to 1, 2, and 3 billion in the last several years, and it's been through acquisition.
Right.
And I think that's another area where being able to have the data and the information as an advisor can only help the success. And it really also, I think, comes back to the model at Brightscope, which is, fee compression is a natural in every industry. Commoditization is a natural in every industry. And driving down fees in one area where an advisor then gets paid more in another area is justifiable and reasonable, but scale is going to be a driving factor in that. The more assets, the Walmart model, the more good that can be done. So I just throw that out as you started to make me to think about what you have and the capabilities would be really valuable.
Yeah, and if you're viewing data as a strategic asset, as we do, you don't have to be in every business. We don't actually have to be the person that matches the older advisor with the younger advisor or facilitates the transaction. But if we're the data set, the richest data set, and we're powering through an API or some sort of link between that platform and our platform, then we can drive better decision making in a lot of contexts without actually being the broker, without actually being the person that's conducting that business. So I think there's a lot of different businesses that will evolve to take advantage of increasing transparency and big data and more information sharing between firms. One of the most interesting things that we're doing as a firm right now is building a massive data clearinghouse, an exchange, which will allow a lot of financial institutions that already share data between them to do it more efficiently. So functionally what you have is a lot of custodians and BDs trying to disseminate information to asset managers, and you have asset managers trying to send information between themselves, and sometimes you have 100 different file formats going between these firms on a daily, weekly, monthly basis, and it's really inefficient. And so each firm is duplicating effort in terms of IT staff and code and whatnot. So we've essentially stepped in and said, look, we'll provide a common protocol and standard. All you have to do is provide us with the baseline data that you're already distributing. We'll make sure that it gets to all the folks on the other end, and we'll send it out in a clean format that's already available in their system, so they don't have to do any extra work once the data arrives on their side of the wall. And so that's the type of thinking that we're doing, and that can extract tens, if not hundreds of millions of dollars out of the system. And while it won't immediately filter down to the consumer, it's just a matter of time between when a business figures out how to get operationally more efficient and when those benefits start to accrue to the end buyer of the products that those businesses make.
So I have to ask you, since you were launched or announced something you hadn't announced yet here on this interview, the measuring influence, is there anything else coming down the pike that you'd be willing to talk about that you're considering or looking at?
I mean, I already mentioned that we want to build more tools for consumers relative to insurance and annuity products. No one's done that. I assume there's some startup somewhere that we haven't even heard of that's working on that as well. And it's great. I mean, if someone gets there first and they do it well, we won't even go there. But my suspicion is that we'll still be sitting here 2 or 3 years from now and it won't have been done right. So we'll end up going there as well.
That's fantastic. Well, Mike, I really appreciate your taking up this time. I know how busy you are. I know you've got a lot of plates up in the air, and the work that you're doing is really having an incredible impact. And you're one of those brilliant, as I said, maverick thinkers in the industry. And I want to let our listeners know, how can they be in touch with Brightscope? Where should they go to get information about you and their company?
They should go to brightscope.com.
Okay.
They should be able to find pretty much everything that they're looking for there. And we're a pretty easy company to reach in the digital environment because that's sort of how our company was built.
So for those of you that are on this listening to it, or going to be driving in your car listening to it, and you have never looked at Brightscope, be sure to go to brightscope.com. Those of you that are using some of the tools at Brightscope, it's time to expand out and take a look at what they're doing, especially in this area of building your brand and eventually measuring your influence. And I also want to let our listeners know that Mike at Brightscope have been kind enough to come on board as a sponsor of our Big Idea Focus Group that's going to be launching in Chicago, November 17th and 18th. So if you're listening to this and you want to learn more about that focus group, this is a mastermind group. It's going to be 50 top advisors around the country coming together over the course of a year. We're going to launch on the 17th and 18th in November in Chicago. We're going to have monthly mastermind calls. We're going to have quarterly tele-webcast calls. So you can go to the 401kcoach.com and register there, or you can give us a call at 877-932-6236 to learn more. And Mike, I really appreciate your being on board. And as always, it is a thrill and exciting to see how fantastically Brightscope has grown and the impact that you're having, and just being a part of that, both as a coach and an advisor. And thanks for helping us grow our business as well.
Thanks. We love watching what you guys are doing over there as well. So thanks for thinking of us on this opportunity.
Appreciate it.